Hello, everyone. I'm Miles. In investment banking, leveraged buyouts, LBOs, are crucial because private equity funds are among the most important clients. An LBO is when you acquire a company using a combination of debt and equity, and then use the company's own cash flow to pay off the debt. Imagine taking out a loan to buy a rental property, using the rent to pay the interest, accumulating equity through the net cash flow from the rental business, and finally selling the property to pay off the principal and make a profit. That's the most straightforward example of an LBO, and it's also the purest demonstration of risk and return in finance. Today, we'll use a case study to calculate the internal rate of return (IRR) for an LBO, while also revealing the 5-step logic behind an LBO. Step 1. Assume the company's valuation, or enterprise value, EV, is 5 times EBITDA. EBITDA is 100, so the purchase price is 500. The financing structure is 300 in debt, with interest paid annually and the principal repaid in a lump sum at the end. That's called bullet repayment. The remaining 200 is equity, which is your own investment. As EBITDA grows each year, after deducting all operating costs, including debt interest and taxes, the leveraged free cash flow, LFCF, equals 20% of EBITDA. Step 2. Sources and uses of funds. The 500 purchase price is paid with 300 in debt and 200 in equity from your own pocket. Simple, but it lays the foundation for the core of leverage. Step 3. Forecast EBITDA and LSCF. Within 5 years, EBITDA increases from 110 to 150. Leveraged free cash flow is 20% each year. 22, 24, 26, 28, and 30, totaling 130, all of which goes to the equity investors. Step 4. Debt. Because it's a bullet structure, only interest is paid each year, and the principal of 300 is repaid in full at exit. Therefore, all the LSCF during the holding period belongs to the shareholders. Step 5. Exit. In the 5th year, EBITDA is 150, and the valuation still uses a 5 times multiple. Enterprise value, EV, is 750. Subtracting the 300 in debt, the equity from the sale is 450. Adding the accumulated free cash flow of 130 over 5 years, the total equity amounts to 580. Compared to the initial investment of 200, that's a 2.9 times return. The multiple of invested capital, MOIC, is 2.9. The annual IRR is approximately the 5th root of 2.9 minus 1, which equals 24%. Please note, every step is closely linked. Assumptions about financing, projections, debt, and exit. With just one problem, you've mastered the complete framework of an LBO. Leverage itself doesn't bring higher returns, but wisdom, discipline, and practice can harness leverage. LBO integrates growth, cash, operational improvements, and capital structure into one. That's why LBO is a required course in financial education.